Good morning. It's a pleasure to be here and moderate this discussion on the topic of thriving in an imbalanced world. We heard very eminent speakers in the first session talk about the challenges that we face and also the opportunities that it creates for us. The way I would like to structure the discussion is set the context, and then I would like to invite each one of the panelists, and as Mr. Ashok said, we have a very eminent group of panelists who are leaders in their specific industries and who can bring their deep experience as well as the knowledge of the different sectors into having a very engaged discussion on this important topic. I'm going to invite them and then for saying a few words based on their experience for a couple of minutes, and then I would like to explore a couple of themes that have been presented around this topic, themes based on the experience, and then I will open it up for questions from the audience. Before I jump into this discussion, I just wanted to share a piece of analysis and data from some internal research that we have been doing within BCG. You know, as we look, and all of us who are operating in the industry, as we look at the external environment, this whole question of what will make us compete and what will make us win in this environment is a question that's there in top of our minds. So we have been researching this topic as well, and last year there was some very interesting data that came out. If you look at the period between 1960 and 2010, 50-year period, and look at the industry leadership, what we found was the volatility in not just the external environment in terms of exchange rates or commodity prices or repo rates or Sensex, but also the volatility in the industry leadership has increased tremendously. In fact, what we realized was a leader of an industry, the chances that he would remain a leader after 3 years had gone down by 50%. So more than 50% of the industry leaders would not be leaders within 3 years. And also, the profitability of these leaders to the market leadership had also gone down. So it is less than 10% probability that a market leader is also the profitability leader. That's what this kind of uncertain environment, this kind of a tremendous volatility that we see has done to the industry structures. With this, what I like to do is maybe start off with Dr. Forbes. He is the director of Forbes Marshall, but also a very deep thinker on technology and leadership. I'd like to invite him to talk about the challenges that they face in the capital goods industry. If you look at the index of industrial production over the last few quarters, every month and every quarter, it's been showing going up and down like a yo-yo. Even the economists have started questioning the data behind it. But given that they operate in this sector, how have they been able to address some of these challenges that they faced in their business?
Thank you, Arindam. With your permission, I'll speak from here. I think it'll be easier that way. A couple of background comments first. There's a saying by Confucius. I mean, it's a very good thing to quote Confucius because you can usually attribute almost anything you want him to have said. Confucius was supposed to have said that may you live in interesting times, and he meant this as a curse, not a blessing, because he said, well, the good life, a life of contemplation, a life of civilization requires stability. But this imbalance that we're talking about creates both opportunities and it creates a lot of change in how we see the world. As Mr. Muthuraman mentioned earlier on this morning, imbalance isn't new. It's been with us at least since the Industrial Revolution. If you go back 200 years, the richest country in the world was about 3 times richer than the poorest country in the world. If you look today, the richest country in the world is about 400 times richer than the poorest country in the world. So there's been this 2 orders of magnitude increase in imbalances, but over a 200-year period. And this kind of imbalance and volatility is, as we heard earlier on, only increasing. Now, many nice things were said, both by Ashok and Arindam, about how we've handled some of these issues in our own organization. I want to stress that this is very much a work in progress. And what I'm going to try to do is to give you a sort of state of where we are at present. About a year ago, we found ourselves as a company in a rather interesting position. We were coming off 5 years of very solid growth. Our board was telling us, which was sort of an interesting comment, they were telling us that they thought we were too profitable. And they said, so what are you going to be investing in? They've been telling us this for the last 2 years or so. So about a year ago, we embarked on a whole series of investments. Investment in a whole new factory complex about 30 kilometers from where we are now, which would be essentially something that would take care of our needs, we think, for the next 20 years. A new ERP solution. As you know, typical ERP solutions are those where the supplier gives you the software for free and then charges you half your turnover for the implementation. And going with that also, a major investment in people, where we increased our employment by about a quarter to cater to this new factory that was going to come up, and an increased sales force. So all of this about a year ago. So this huge increase in investment at precisely the time that the project business and the capital goods industry turned down. So we said, okay, so how do we deal with this now? Because we're simultaneously investing more than we've ever invested before as an organization, at precisely the time that the capital goods industry is turning down. We're seeing negative growth in some businesses. So we started doing a few things. First, and these comments are sort of organized along the lines of the BCG report and the six key themes. First, in terms of de-risking the business, we get business from 2 areas, 2 parts of the market. We get business from a project market, people setting up new projects, and we get business from existing plants that are trying to get more efficient, or the actual user market. So we started focusing very much more strongly on the actual user market. And in particular, we started focusing much, much more on services to the actual user market. Because that has a dual benefit in that it tends to become more of an annuity business, a business which you can count on in terms of a revenue stream month on month, as opposed to being determined by the market. So it's something that is much more within our control, and a reflection where results are a reflection of what we do as opposed to being a reflection of what the market does. Second, we started focusing very much on the international market, in particular 3 or 4 countries in Africa. And both these initiatives have actually paid off very nicely in this last year, to the point where if we look at where we are as of now, we'll probably end this year in another week, maybe 5-6% up on last year. But that involves about 25% growth in actual user business. It involves about 40% growth in international business, and it involves about minus 25% growth in project business. So if we hadn't done these things, we'd have been in much deeper trouble. Going with this de-risking of the business as a part of the Chakan project, what we decided was that we said, well, yes, it's going to involve this big investment. The first key thing is that regardless of what happens, the worst case scenario, we have to still be in business. So we worked out a scenario where we said 5 years down, if 5 years down our turnover is the same as it is now, and that hasn't happened in the last 25 years, but if it's the same as it is now, then we should still be in business. We should still be profitable as a company. And what does it take to do that? Even if it means scaling back on the project, if it means doing the project more slowly, as a basic minimum, worst case scenario, we have to still be in business. So we started with that as an absolute. And then we started building in flexibility into the project itself. So we said all the buildings that we're putting up are, and we make boilers and we make electronic instruments. So stuff that is of a very different size. But we said every building that we put up should be flexible so that if we want to convert a boiler factory to an instrumentation factory, we can, or vice versa. And it doesn't matter if that means that the actual capital cost of the factory is actually 25% higher. We should have that flexibility to be able to move one building from the production of one item to something that is completely different. It was a very conscious decision. Our architects thought we were crazy, but we think it's the right thing to do, to build that flexibility permanently into the physical infrastructure that we have. Finally, a comment on the planning process itself. And there were several, I think, very interesting and useful comments on budgeting and how one should go about it. What we found particularly useful is to use scenario planning, to say, what's a worst case scenario, what's an optimistic scenario, and what's a most likely scenario. And what we've started doing with scenario planning is to split all of our forecasts into two pieces, into a stable annuity dependable piece, things that where the results are going to depend on what we do, that actually use a business bit, the services business bit, and the volatile piece, so things related to projects and so on, where the market's going to give us what our results are. And when we've done that, what we do is that we update the volatile piece on a monthly basis. So the volatile piece is a monthly forecast, looking forward 3 months, and we don't expect it to be accurate for the year at all. But the other part of the business, we think, is a much more stable part of the business. That's what history shows, and that's something that that we can count on and can plan on a long-term basis, and where we can have a much more accurate forecast. I like very much the comment about changing the way in which this is managed from a people perspective earlier this morning. And I think that's something we haven't done. That's something that we can very usefully go away and do, which is to look at how one builds that flexibility into one's people systems as well. It's something that we, I think, have struggled with as an old-style firm, that where we can have greater decision-making devolved for those stable parts of the business, and then have a much more agile, quicker, responsive decision-making centered in a small group for the volatile part of the business. I thought that was a very good idea. Thank you.
Thank you, Naushad. In fact, we will explore some of these themes in a more interactive way. I like to move from capital goods to a very, very different industry, the infrastructure industry, which is one sector that we know has been hit very badly by the recent volatile environment that you have seen in terms of interest rates, in terms of the demand going up and down. So I'd like to invite Mr. Reddy to speak for a few minutes about what they have done as a company to be able to address some of these challenges.
Thank you.
Just a request that if you can just limit yourself to a few minutes so that we can have a more interactive discussion later.
Certainly. I think I was told 5 minutes, so I'll make it 4 minutes. So I think I'd like to maybe just focus on one aspect of risk. Our business is quite different from most other businesses, because being in an infrastructure business, we are more project dependent. We have projects in power, in roads, in ports, in airports. So it's not as easy to plan, and anything we plan, the outcome of which will only take 3 to 5 years to see the results of this planning. So we are quite a different business. So I'd just like to spend a few minutes on risk. Today is a very volatile world. There's a lot of imbalance, and there's a lot of challenges. But so are the opportunities. So the biggest issue is how do you balance both these, the challenges and the opportunities? If you look at purely the challenges, then obviously we will start becoming much more risk averse. We will start looking more inward. We will forget about growth, which, as I said, since our reaction time in terms of our output of our decision making takes a long time in the infrastructure business. Can we do that? Or do we continue to grow and forget about these challenges? I think these are things which, for us, is the biggest issue that we had to face. And a few years ago, when we looked at risk, I think from a broad macro perspective, we saw risks in 2 areas. Our business itself, infrastructure business, has a huge amount of inherent risks because of the fact that it is linked. Our counterparty is government on all our projects. Politics plays a very major role, especially lack of stability. And India as a country, while it has huge opportunities in infrastructure, so are the challenges and so are the risks. Secondly, as a country itself, India, we believe very strongly long-term as an infrastructure business. Everybody talks about $1 trillion opportunity. So it's a huge opportunity. But yet we felt that we should de-risk ourselves. So in these times, we took a decision which last year was very bold because we certainly believe that fortune favors the brave and the bold. And so we took a decision to take up an investment in primarily 2 countries, Indonesia and Australia. And in Australia, we've taken a decision to take up a project which is larger than all the projects that we've ever taken in our history. It's a $10 billion investment in Australia. So the question is, only time will tell, but in terms of risk, I think, one can always look at it in different ways. So we believe in 5 years, we'll be a totally different company because of the risk that we took in taking up these decisions. But obviously, time will tell. There's a lot of work that has to be done. So risk is not necessarily can be seen only in a negative way. There's also in a positive way we can look at opportunities and balance risk using opportunities. So I just wanted to make this one point. Also, another point I just wanted to make was, if I look always, one of our most challenging projects was Mumbai Airport. When we bid for it in 2005 and won it and took it over in 2006, how would we view that project today? I think we would view it quite differently because we've learned a lot of lessons in the last 5 years. So I think this whole area of risk for an infrastructure business is very critical, and how we balance the challenges and opportunities. That's the only thing I wanted to point out.
Thank you, Sanjay. Turning again from the infrastructure to a very traditional industry, which is automotive industry. Ashok Leyland, Sesh, has been one of the companies that since its inception 1948 has been steadily growing and obviously weathering all kinds of external environmental shocks. So Sesh, if you would be able to share some thoughts, you have been leading at the helm of this company for a long time now. What has been the secret source of success for Ashok Leyland to be able to maintain this steady growth despite whatever be the turbulence in the environment?
Thanks, Arindam. First, my sincere apologies for turning up late. Yes, we belong to an industry which is notorious for its volatility. In fact, so much so that if times are good, we begin to worry. Something must be wrong. Actually, this quarter, I was planning in the early part of this year that there would be a distinct slowdown in this quarter, January, March. And when it didn't happen, we were all getting very, very worried. So this is pretty much, we are hardwired into this managing the volatility. But I heard when I was walking in, Naushad say that the world has always been imbalanced, unbalanced, and he's said over 200 years that this has been so. I think we can manage the 200-year volatility bit. But I think what we are going to be witnessing now in the next few years, in the next decade, is a sort of volatility that we haven't witnessed in the past. And that's going to be extremely different. The amplitude of change itself is going to be very, very large. We have seen in the past markets move up or down by 10-15%. What we are seeing are violent swings in the marketplace, or exchange rates, or commodity prices. And these are all not necessarily rational. So we are going to be dealing with an environment which is going to be extremely volatile, and that is partly, in my view, is on account of the fact that we have today a globally linked marketplace. In the last decade, when several countries opened up, and we have therefore trade moving from one part of the world to another part of the world seamlessly, and also more importantly accompanied by very large movement of capital and currency. And that has made the entire world environment, global environment for market, for industry and business extremely volatile. We just have to consider that we do not have a regulator at the global level who is going to be managing volatility on currency movements or indeed even commodity movements. I will not be surprised if Sanjay in the next 1 decade begins to control coal, and time will say that he will certainly be the king of coal, and at that time there would, his ability to move from Indonesia to Australia to India, wherever else, is going to be a huge challenge in terms of the volatility of the pricing. The larger business interests in commodities which move around the world, and the ability of these businesses to be able to therefore determine the price ranges in which they operate will make a huge impact. And I think this is the new environment. This is, I think, what I saw in your work as the new normal. I'm not sure it's the new normal, it's the new abnormal that we have to be dealing with. I would only make 2 points before I pass on in the context of how do we therefore confront this new abnormal. The one is, I think we need to be looking at where each of us wants to position our business in terms of our risk appetite. This is fairly well done in the banking industry. In banking industry, thanks to a long history of regulation, every bank chooses to position itself in terms of the risk return. And in fact, a regulator would like to keep the risk return fairly under control, a good regulator. We have seen unregulated market where the risks are huge, the returns have been huge, the losses have been huge, and we have seen failures. But in a well-regulated market, the risk return matrix is fairly well controlled by the regulator. The banks position themselves in that. They're not allowed to take high-risk positions. But there is no such thing in other businesses. So it's up to really the board to decide where do you want to position. Quite often, company boards do not spend time to identify where do you want to position the company in relation to the risk. You can be a low-risk company still looking for growth, but then you're not going to be grabbing headlines. You're not going to be looking at huge risks to be taken. That's a position which is perfectly legitimate to take. You can say, I'm not going to go down if the huge risks strike me, but I'm not going to also grab the headlines if opportunities present too much. But I'm going to be making a steady kind of a trot, and I'm going to be growing at 15, 16%. So that could be your risk statement, a position. Or you could have a position for the business to say, I'm hungry for growth, therefore I'm going to be taking risks, and therefore I'm going to be seizing opportunities. It's perfectly legitimate to do that as well. When you do that, I would only think that one has to look at what Rumsfeld Donald Rumsfeld talked about in terms of the war risk of known knowns, known unknowns, unknown knowns, and unknown unknowns. I think the known knowns purely are operational kind of risks. And that's something that you can manage. You can have BCG come and tell you exactly how to map your processes, where the risks are operationally, how to manage those, and we'll have a perfectly well-mitigated risk position. The known knowns are easy to handle. The known unknowns and the unknown knowns are truly the big areas. What will you do if there is going to be a huge change in the currency position? What will you do if there is going to be a huge issue relating to the commodity availability? What would you do if there is going to be a market swing change as a result of some breakthrough technology that is coming about? These are known unknowns or unknown knowns. And as I think I heard both Naushad and Sanjay say, it would be necessary for building up scenarios, will be necessary to place your bet as you want to be. But my little experience says that we're going to take big bets on businesses which are exposed to big risks, the known unknowns or the unknown knowns. You must be financially low risk. If you're going to be financially high risk, if you're financially high leveraged, and you want to take business risks with a lot of known unknowns and unknown known risks, then you're asking for trouble. So between the business risk and the financial risk, if you want to play a big business risk game because you're looking for your appetite for returns are very high, play a low financial risk. But if you've got a lot of financial risk already, then play a low business risk. I think this is one lesson which I would want to place on the table for discussion. The last point I'd like to make, I think there is, as Sanjay was saying, there is an opportunity every time that there is a business risk, that there is a market risk, there is also a huge opportunity. And that requires a great degree of agility in understanding market trends. Your ability to take the straws in the wind, read the future from the present. Every future is embedded in the present. There is something of the future that you can detect in the present if you're just being careful. If you're just watching for that little trend, that little spark, which you think is going to be fire, and in the marketplace, in the customer behavior, if you can spot that, then there is an opportunity. And if you can just develop that and move forward on that, then you're de-risking the business because you've got a first mover advantage on that. And that is the opportunity that every environment provides. So there is a greater degree for sharpness of understanding in terms of market behavior, small changes in the market behavior, customer behavior, the trends that will then become a major transformational change. Thank you.
Thanks, Sesh. Let me now turn over to Ganesh. He can bring a very, very different perspective of a global organization operating in markets which are high growth, also markets which are very low growth or negative growth. And obviously, given their global footprint, have to address a very different set of risks associated with this volatile environment. So Ganesh, would you like to share as DELL how I've been dealing with some of these challenges?
Yeah. Thanks, Arindam. You know, I got to admit, when Ashok introduced us, he said some of us are outsiders. I think he meant me as an outsider. I live in Bangalore, but I am from Chennai. I went to college here. It's very interesting to see this many people show up, because when I was telling my wife I was going to go to Chennai to speak at a conference on Saturday, she was saying you're going to speak to each other and to a small group of people. But it's interesting to see 400 people turn up. You know, I'm an outsider only because on this stage I represent the technology industry, where the volatility is defined not in years or 20 years, it's defined in 2 years, in 1 year. Whoever is the industry leader last year is not an industry leader today. Startups and new technology changes can create risks which are totally unknown, as Seshasayee referred. If you look at DELL's history, we have been pretty successful as a hardware vendor. We have been here for 25 years globally, 10 years in India. What we found ourselves suddenly after 20 years is we were in the commodity trap. We became number one. We had pretty big market share in the top 10 countries. We were a successful PC vendor and server vendor. Then we found ourselves not growing, not being profitable, and ready to fall into the commodity trap. One thing we did, which is interesting to share, is we redefined the industry we participate in. From hardware, we said we wanted to participate in the total IT services space. All of a sudden, you find that the IT services industry is a $3 trillion industry. And we are a $60 billion company. So we have 2% market share in the industry. So even if you look at the top 10 countries where we are big, we don't have more than single-digit market share. So it completely changes your risk profile. So whatever happens to the economy, whatever happens to all the volatility, the 3 trillion can become 3.5 or 2.5. We are very small. So that mindset changed our attitude, where we invest in and how we participate in this. The second point I would make is about what it drove in terms of budgeting process. If you look at corporate America or big global companies, the budgeting process is a negotiated budgeting process, right? The board, you submit a plan to the board, you keep 10% because you know you need a hedge. And then you pass on the 10%, you pass on the 10%, and ultimately everybody has a hedge so that they're not taking any risk. And then we turn around and say, we'll do a full bottoms up. Everybody should put in everything they've got. They know that they're not going to put everything they've got. They're going to keep that 10%, and it flows up the same way with 10% hedge everywhere. So what we decided to do was, we used to have a saying in Texas, when Dell grew up fast, it's always under-commit and over-deliver. You always want to set low expectation and over-deliver. That necessarily didn't drive the behavior we wanted out of our organization. So what Michael tells today is, if you set 10 objectives and hit all 10 of them, you're actually doing something wrong. You probably want to miss 5 of them because you're setting some big objectives. So we do a budgeting process where we have a base plan where everybody can get decent bonus. And then we turn around and say, what does the full potential plan looks like? Which we have no idea of how we're going to get there, but we'll get there. We might get to 10% of it, we might get to 20% of it. And now that becomes a new baseline for next year planning, which is a different way to look at the budgeting process. The one last point I would make is the organizational structure. When you go from a very small company, and I've been in Dell for 13 years, when we were a very small company and we all of a sudden became a big global $60 billion company, you find that invariably a lot of bad behaviors set in. You find 2 things happening. The organization decision-making process slows down, the risk-taking appetite slows down, and you will find that for every $1 of revenue, you got 4 or 5 people taking credit for it. Right? I mean, you got regional structure, you have a product structure, you've got so many overlay organizations. So everybody can take credit for that revenue, and when revenue doesn't come, everybody knows who else to blame. So we wanted to make sure that these kind of overlay organizations don't exist. You take $1 of revenue, you can put it on somebody's forehead, and maybe 1 or 2, not more than that. I think that is, you see the IT services industry going down that path now. They're cleaning up a lot of these verticals they have created. The other thing which is related to the organizational structure you would see is when you are in the growth phase, you will find that people are adding lots and lots of layers in their organization. We found all of a sudden from Michael Dell down to the frontline salesperson, there were 11 layers. 11 layers across that organization. And people having 5 people, 6 people, 7 people reporting to them. And we decided that what we wanted to have is 7 layers max. And this is not a one-time exercise. You got to keep doing this every year. And what you would find is even in industry which has got 50, 60% gross margins, they don't have to worry about so much OpEx. Doing this exercise every year helps you to streamline the organization and fasten decision-making process. It also helps in risk-taking because now you have people who have got some big jobs to themselves so they can afford to take few risks. The other 2 points which came out of the report which applies to us, and I won't elaborate on them, which is avoiding the commodity trap. We're putting a lot of investments into creating IP and acquiring companies to not go into the commodity trap of the world. The final one is, Dell didn't acquire any company in the first 15 years of our existence, 20 years of our existence. In the last 2 years, we have acquired 12 companies. And we have learned that running a successful company is very different from acquiring and integrating new companies. And having a robust acquisition and integration engine is very critical in this stage for growth. Thanks.
Thank you, Ganesh. One of the most frequently used words in all the 4 panelists when they talked about was risk. So this is a thing that I want to explore in the next few minutes, but I just wanted to tell a little bit of a story from some work that we did as BCG. You've all heard about the challenge that the Japanese automakers faced when they had first tsunami, the Fukushima problem, and then most of them, pretty much all of them, have large investments, asset investments footprint in Thailand, and then there was this flood in Bangkok. So suddenly they found that their production lines are stopped. And one of our clients, when they started investigating why it was stopped, they realized that there's one supplier who's a tier 3 or tier 4 supplier supplying a very specific technology, not a high value, but very specific technology that was going to a tier 2 product. And there were several suppliers in tier 2, but they had not really drilled down to understand the risk in the supply chain. And when this factory, and there was one factory that could supply that specific technology, got flooded, the line was stopped for a couple of weeks until they were able to make alternate arrangements to be able to manufacture. And that taught this company a really hard lesson of how to manage risk. And we saw 2 dimensions of risk in today's discussion. One, Sanjay said that there is a huge opportunity in today's volatile environment, and GVK as a group has made a huge bet in Australia in resources, and also looking at making a big bet in Indonesia. And then you had Sesh taking a more balanced view about risk and return profile, and driven by the board. Now, what I like to explore really is more at a tactical level, what kind of steps, techniques, or processes that some of the companies have put in place to be able to address this when it goes beyond just tick marking the box, which is all what most of us wanted to do. Maybe I'll start off with, again, Sesh, when you said that we have a good balance, how do you drive it down into the organization, into your decision making at a pretty kind of normal level, rather than only at the board?
Well, as I said, if we have to map our risks in terms of, again, I go back to Rumsfeld. By the way, as I said, the known risk BCG will solve, and the unknown risks only God will solve. So we're only talking about the known unknowns and the unknown knowns, right? Now, I think at the strategic level, this really captures the strategic risk. And if I were to therefore look at our own experience of how we managed to do it, about 14 years ago, when we had 16 years ago, when we had this huge downslide in 96, 97, just after that, when we had the market collapse by about 35%, when we were all on a go mode, it was evident that we had to do something even better than what we had done in the last 40 odd years in order to manage the risk. And strategic level, therefore, we said we'll have to balance the portfolio. And just as Naushad was saying, you got to have something of an annuity nature, something which is not susceptible to that kind of volatility, giving you the bread and butter, which will enable you to pay your bills and salaries and pay your interest costs, and you play for the other part in terms of various levels of risk. So we, in fact, I would say in the last decade, we have a portfolio where you've got some steady business coming in. So it is not susceptible to volatility. At least relatively so. For example, we have a power solutions business, which is fairly steady, given the fact that our power deficit in this country is fairly steady, so our power solutions is fairly steady. And given the fact that the bus market is a fairly steady market, we have a very strong presence in bus market. So these were parked in the part of the portfolio. At the other end of the spectrum, We also committed money in developing new cutting-edge technology. I mean, just to give you an example, we went and established a greenfield site in a greenfield factory in Germany, in Dortmund, to develop a new SCR system because emission control was going to be a part of the legislative requirement, and we said that we must have something breakthrough. And that's taking a bit of a gamble to see whether this technology is going to work. So in your portfolio, very much like what an investor would do, you say that I've got something on the debt side and I've got something on the equity and I just play also on the growth stocks for a while. So if you want to balance your portfolio, you're going to do something on the property, something on your gold, I think you would do a very typical kind of an approach even in the business. That is the first issue of balancing your portfolio. And the other is you refer to the processes for doing this. And I think it's a very important point. To be able to drive processes to manage the risk, I think, is an extremely important issue. And that happens by the process of getting each of the functional head to identify the risk. We have today a fairly good, robust system of capturing risk in a risk matrix, identifying the probability of risk, and then mitigating this risk, and making sure the organization is made alive and conscious of the kind of risks that are facing in each of this function and take advanced action on this. I think this process is important. But what is a very interesting issue on this, that how do you organizationally structure this? There are different solutions to it. You could have a risk office, which is only focused on managing risk, or you could just be looking at the CFO being the risk officer who's able to give a mirror of the risk that the business is facing, or you could have the business planning department to do this. There are different solutions to different businesses, but that will be an interesting thing to discuss by itself.
Sanjay, you talked about taking a big risk, also an opportunity, but how have you driven down the risk management in your organization, and what are the modifications that you've done in some of the internal processes to drive it down?
I think in our kind of business, at least at the stage of evolution that infrastructure is, I don't think we can actually drive it down. It's very difficult because most of our decisions are either strategic in nature or capital intensive. I normally say that in infrastructure business, capital is a raw material. And the smallest project that we've taken up in the last few years is 1,000 crores. So you can't actually delegate such decisions. So it is, most of these are very strategic and capital intensive, so it's very difficult to delegate.
Naushad, would you like to share from your experience what you have done?
It's not something recent, but our approach has really been a culture approach more than anything else, which is that if we're very picky about sometimes very small things in the company, and very picky about them and spend a huge amount of time on them. So for example, we can have these long discussions on a car policy, and it'll go on and on and on for hours. But in the process, what ends up happening is a sort of common approach to thinking about people, to thinking about rewards, to thinking about fairness, to thinking about how do you apply judgment on the basis of need versus entitlement, and that common sharing of perspective and culture then I think permits a great devolution of decision making, because you can then actually let big decisions be taken down the line when you're picky and sometimes centralize very small decisions. So we have this sort of weird combination. I'm not sure it fits it. I'm not sure it comes out of any management textbook, actually.
No, I mean, that's interesting. So do you have that kind of conversation around risk in the top management?
Yeah. So for example, let's take an example about whether a particular order should be taken at a particular price level. Yeah. Or let's say a particular order should be taken for a new solution that we've never done before as a company. Yeah. Those decisions will be taken usually by the business head, by the sales head, with his field sales counterpart. And these are big decisions. These are decisions that where if they go wrong, they could be, for a company of our turnover, which is a few hundred crores, you could have a 5 crore, 8 crore hole as a result of one of those decisions being taken. But we will then centralize very small decisions sometimes. So it's this strange combination, I think.
I was very tempted to give a story listening to Sanjay. This is, if I may take a minute, this is about a bard, a poetess, Avayar. Some of you from Tamil Nadu would have heard of this old lady who was a bard. And she had a lot of friends amongst kings. And there was one particular king who was a very good guy, who was a warrior, and he captured several neighboring kingdoms, and he was all the time busy winning wars. She also had another guy who was a bad guy, and the bad guy was, of course, extremely proud of all that he already had, but wasn't winning wars. And he was very furious that Avayar was constantly composing poems in praise of the good guy, and therefore this guy said, "Will you come and visit my kingdom?" And so the Avayar went and saw, and he showed the armory, and Avayar went around and said, extremely impressive, very well stored, everything is neatly binned, and there is a tag attached to every bit of the armory. And and he said, "What about the other good guy, this Adiyaman who you keep praising, and how shabby it is?" So she said, "Yes, it is very shabby. And when I go there, I find that everything is in chaos, all the armors are thrown around. But you know what? They're constantly in use." So I was reminded of that, when Sanjay said that, I don't know what the process is. We take decisions, we move forward. So he'll go and get this because he will want to go into Indonesia or Australia because he senses an opportunity. And so the BCG can wait until they come and do the processes, but the decision is made. So, but on the other hand, and I say this quite seriously, and I say this not in jest, I say this seriously, that the top management, if there is too much of an obsession about getting into procedural compliances, making sure that risk registers are properly written and so on and so forth, I think you lose the wood for the tree. And I think there is a very important balancing. I would very much say that the top management need not be too concerned about the compliance and the finesse of the process. So they're good, they are required. But I think the big moves have to come from strategic, intuitive decisions rather than BCG-driven processes.
Sesh, I've known Sesh for a long time, so I think Sesh is taking those cracks at me. So anyway, there are enough jokes about consultants, so I've got quite immune to this by now. So let's moving on. One of the things that probably we haven't given adequate thought of, and which is very important, which was touched upon in the presentation that was made by Sachin, and I think Naushad also brought it up, is the whole issue of agility. But at the end of the day, agility is also about people, and how do you make people agile? How do you make them experiment? How do you make them take risks and learn and change? That's very important. And then we also heard about, this is an opportunity to create burning platforms to create major transformation. So maybe this is a topic that I'd like to explore a little bit. Maybe with Ganesh, you referred to some experiments, some things that you have done in DELL. What has really worked in engaging people on this to create more agility in the firm?
One thing which has worked for us is that we have the CEO whose last name is on every building. So obviously there's a lot of ownership from him, and a vision and an urgency which is driven from the top, which is actually a big part of our transformation. The second thing which has worked for us is consistently defining us as an underdog in any industry has worked for us. So when we became big and we started talking about we had #1 market share on this and #2 market share on this, we kind of lost it. When we turned around and told ourselves that we have single-digit market share we're nowhere in India. We want to grow in India. It helped us to become number one in India in 5 years. So consistently being an underdog for us has driven a kind of passion in our people, which has worked for us. The third thing which worked for us is there's a lot of discussion about risk. One thing we worry about in this industry is we don't have people taking too many risks. We want to make sure that the small business mindset of taking risk within the broader reputational side of the business is prevalent in every part and every function. So that's why we have defined our industry not as a big one company, but 10 top 10 markets we want to compete in, and the next 10 we want to get into, which actually gets teams going in a small setup with very limited resources, where they can actually bring in a small business mindset and an ability to take risks much more than what they would do if you're operating in a big environment. So those are things that worked in our transformation.
Anyone else? Any interesting experiences from your companies or how you have engaged people in this environment, turbulent environment, to focus around what is important and create a kind of burning momentum? Sanjay?
I think one of the most important things that any company has to realize is what is their DNA. What exactly are they made of? What's their culture? How they approach a business, and what drives them. So, frankly, if you see GVK, our company, we are driven by challenges. So our DNA is to take up challenging projects. When we took up India's first private power plant, there were 300 projects in the race. We were the first, but we were very driven because we wanted to be the first. When we set up again India's first toll road project in Rajasthan, it was a 100-kilometer toll road, which had the highest accident density in Asia. 50 religious structures on the way, thousands of trees, and we had 24 months to finish. We finished it in 18 months. And then when we took up Mumbai airport, I call it the mother of all challenges. We have 80,000 families, 300,000 people, one MLA constituency to move from the airport land into new buildings, and we've already built 20,000 tenements. And next year when the new terminal is open, it'll be amongst the best in the world. So we're driven by challenges. And so in terms of agility, we move from challenge to challenge, which obviously is moving from opportunity to opportunity. So when we took up this project also, I think the simple things for us is certain dots have to line up. The dots in this case in the Australian project, I think is important for me to explain. Number one, in power business, there are no resources available in India to grow. India is frankly in deep shit if, this problem is not solved. Because, you're talking about power problems today. I can't imagine what will happen in 5 years. I don't even know what it's an unimaginable problem. So we said, okay, India needs coal. The second thing which clearly lined up was Australia is the best location in the world for resources. This project is one of the best projects available anywhere in the world. Huge competition. And because the market was bad, we got it at a price which is expensive. It's not cheap, but yet much lower than the value that what we saw. So all these dots lined up. Of course, there are a lot of challenges. So in terms of agility, the way we believe is that whenever we see such an opportunity, we move very fast. We had only a team of 4 people, which I led personally. And we spent 80% of our time trying to see that we win this project. And we came in last as far as the bidder. We were competing against global giants, and we won eventually. Now, in the last 12 months, there are many things that happened which has significantly increased the value of the project. One is the Japanese tsunami. Totally unrelated. What has that done? It has completely shut the door for nuclear power. It completely re-rated coal. So suddenly, coal is seen in a different light, in addition to the Indian opportunity. In the last 12 months, China, which used to be the largest exporter of thermal coal in the world, has become the largest importer. And it's projected that by 2025, China has to import 1 billion tons of coal. India's production today is 450 million tons, entire country. So there are many things which are lining up, which whatever we thought were happening, are happening. Now, I'm not saying that in the next few years some things will not happen which are negative. Today, So in terms of agility, in terms of speed, for us, when we spot an opportunity which we think is aligned to what we believe is good, then I think, we have to move fast. And we really put a really small team, and decisions, that's why, have to be totally centralized. They have to be taken on the spot. They have to be taken on the move, whether in mobile, BlackBerry, on the flight. Literally, frankly, our final bid for this project was put in and worked out on a flight from Australia back to Delhi in 24 hours. So I'm just saying that what I'm relating back to is each company is different, and you see 4 different companies on this table. So what one company does looks crazy from another company's perspective. But you'll only understand it if you understand that company. You cannot relate one experience to another. So I think it's extremely important that this discussion is not a common discussion. It's a discussion in relation to the relevant business, the relevant company, and their capabilities. So I think that's why I think, for us, as I wanted to comment on agility, that's a very, very important thing for us when we see opportunity.
That's an interesting point that when we look at the environment, I mean, there are very, very different perspectives that different companies with different industries, different DNAs would have and how they react. But in terms of some common themes that we just talked about, risk and how do you deal with risk are very different, but you need to make risk a very critical part of it. How do you deal with people? How do you deal with growth? There are growth opportunities. You should not just look inward and become kind of paralyzed in terms of this volatile environment. So there are opportunities as well. So with this, let me open this up for questions from the audience. We have about 10 to 12 minutes of questions. So let me open this up. Yeah, please.
You said that every future is embedded in the present and it is possible to detect. So please detect one for me now.
For you, meaning personally, Ramesh, I'll tell you in confidence. But I presume that your question is there a future embedded in the present for the country? Is that how I interpret Ramesh? Yeah? Yeah, okay. But I think, to my mind, 2 things in the last, I would say specifically in the last few weeks, I've been thinking about. One is this, I have to be careful now in what I'm saying because press is here. One is the political situation. What is quite clear is that, and it's clear to everybody, that there is going to be a regional coalition. Their own policy. But central government is far too away from the public. There's no direct interface. And therefore, there is a greater degree of onus on them for making the reforms which will cause pain in the short term for the public and gain in the long term. And the problem that state governments have been coming in the way, or coalition partners have been coming in the way, therefore has prevented this pain in the short term to take the gain in the long term. The moment fiscal autonomy gets better, and moment the states start getting more of say in the fiscal decisions, they're going to face this very situation, and they're then going to push reforms because they have to be answerable for the gain for the long term. Development will become the agenda of the state rather than of the center. Development agenda of the state accompanied by fiscal autonomy for the state could be a good turning point. Therefore, I do see that out of all this mess, something certainly will come out at the political level, which would be for the good of this country. And a very short point about what I believe is also a major opportunity from a business point of view. I think the point that Sanjay made, I just want to underscore that point. Today, the fact that Indian entrepreneurship is now moving away from India and putting flags all over because they find that investing in power plant in India By the way, I'm stuck also in a power plant in India, as you know. And, and we have more. Getting power plants stuck in India is more daunting than going and acquiring a coal asset, an international coal asset. And the more Indian entrepreneurship goes outside, I do believe that eventually India will gain. Because the leveraging of these assets, exactly the way that Sanjay was saying, leveraging of these assets for the Indian market, Indian gain, is going to be a huge opportunity. So I do see, therefore, the two very, very bright prospects coming out of this. Thank you.
Yeah, hello.
Can I, hey, Sesh, walking the talk. More questions, please?
Yes, please. Here.
Please.
Can I? Hello.
Sorry. My name is V.K. Matthews. I'm CIA State Council Chairman, Kerala State. My question is, thriving in an imbalanced world, one of the most important things is agility. And most of what we have discussed so far has been how organizations should be agile and what is it that they should be doing with respect to risk, with respect to planning, all of that. That is good, and that is to some extent probably within the control of the companies. But if you really look at agility also, if you all of us operate in a particular environment and in an ecosystem, and though Sanjay has gone and we are all doing work overseas, most of our success will depend on how the ecosystem, the business-friendly ecosystem that we have in our country. And we have been seeing, I'm sure all of us know, World Bank has come out recently, a survey of the degree of difficulty in doing business in 183 countries. And we were 132 in terms of the degree of difficulty, and which is even greater difficulty than Bangladesh, Pakistan, and Sri Lanka. And we have seen last week the union budget as well, and very little reforms. And so what is it that we should do as a community, as a group, to improve that ecosystem, which is, I would say, according to my opinion, it is going from bad to worse or good to bad. Depends on what part of the curve you are. So what is it that you can actually think that we accept that as an environment and try to be agile taking that? Or should we actually try to do all predictive things to change that particular scenario? I would invite your comments. Thank you.
I'll have a shot at that. First of all, I'd say what we should try and do is what we've been doing in CI for many years, which is to have a clear view on what changes are required, and then to keep pushing that clear view on what changes are required. The only thing that I would suggest is that the more we can turn that clear view into very nitty-gritty stuff on the ground, and the more we can make it changes that will make our operations more effective and efficient, the better. So the more we can bring about local reforms that do not require political change and political consensus and legislation and such, I think the more length we'll get in the reform process. Having said that, I think, from the way I see it, I think that our primary responsibility is to run our companies as aggressively and successfully as we can. And our own view is that regardless of what's happening with the economy, with the political paralysis, whether in Delhi or at the state level, we as a company have to grow 35%. Now, how are we going to grow 35%? So I think the number one source of agility in the heads of one's own people comes from wanting to achieve a lot. Because if you actually want to achieve a lot and you're ambitious, then one is willing perhaps to bring about those necessary changes in how one operates on a day-to-day basis. That agility, I think, it's too easy for us to rest on the thing and say, well, we have to wait for the politics to change. We shouldn't wait for the politics to change. We as companies have to be successful here and now, given the existing politics, given the existing economy, and given the existing paralysis in decision making.
No, I think what the government should do fall beyond the unknown category Seshasayee mentioned. Even God can't decipher what the government should do. I think what we need to do is not being apologetic for the value you add to the country. I think in our first 60 years of democracy, the industry is predominantly seen as a villain. Making more profits is seen as exploitation. I think the organizations like CII and collectively as industry leaders, we need to articulate the value we bring to the society by creating jobs. And there's nothing wrong being more profitable, and there's nothing wrong in paying less taxes to be more profitable because we create additional jobs. We shouldn't be seen as the villain in this space. We should be seen as the one which is driving this growth. I mean, if you look at IT and ITES industry, which I belong to, we have created a $100 billion industry with millions of jobs. First time any graduate who's coming out of a college has a decent shot at getting a job. This industry is not the villain, it's actually the one which has driven India's brand in the world. We want to be very bold about it. We want to send a message so that the government at least wakes up and listens at some point of time.
Can I take the question, please? Can I? Hello?
Yeah, we have time for one more question.
Yeah, thank you. Good afternoon. I'm DSK Rao. I'm an outsider. I come from Hyderabad. I run a knowledge management company. And thanks to Mr. Ashok and CII, in the past I was given the opportunity as a speaker in some of the CII conferences. I just want to clarify, is it a thriving in an imbalanced economic world or thriving in an imbalanced mental world? Because I could see a lot of mental commotions happening across the globe. 99:1, Occupy the World, the Wall Street. Then we had the Anna Hazare concepts here. We had a COO who was killed here. So there is a good amount of, you can say, a displeasure among the masses, the 7 billion, when the wealth is not getting distributed in an equitable fashion. Obviously, that's the next one. So we had, just adding to what Seshasayee has said, we have something known as Arthashastra, which had clearly indicated what he was indicating now, that is, profit should not be more than 15%. Profit and profiteering, actually, and with the radia tapes going along and 373 lakh amounts being put through the corrupt means and the nexus and so on and so forth, don't you think we should have some debate on ethics in industry too, and see that it is not about what's a growth plan, it is a sustainable growth, ensuring that the whole societies grow together. Thank you.
I think we have just one more question, very specific to this topic, if there's anyone.
I have a question. My question is to Mr. Sanjay. I think there is a analysis of the risk management things in various industries and then the business lines. I think Mr. Sanjay said in his industry, basically all decisions are taken at the top, and it is highly capital intensive, highly technology intensive, and highly perhaps government oriented and all that. I just want to ask, Sanjay, his company has taken up perhaps a 10 billion investment thing in Australia. After 5 years, if there are 10 such 10 billion things to be taken up, would he still try to drive it from the top, or would he like to distribute it down the line?
Very good question. I think certainly the answer is yes, we would like to drive it down. But then the question is, one of the main reasons we took up a decision to invest in Australia is because of the management team. That company had already 200 people, Australians, and a fantastic management team. They're really absolutely fantastic. And that gave us so much more confidence of taking that project up. So while one of the challenges that we face as an infrastructure business, again, it's very different from other businesses. Most executives cannot be looking more inward at a business, yes, but they have to be very exposed to external environment. And our external environment is relating to politics, to bureaucracy, to, for example, if I take again Mumbai Airport, relating to social issues, relating to issues dealing with, maybe even to the extent of mafia. So where do you get such managers who can deal with such complex issues and taking decisions? And frankly, even if we get such managers, they don't take decisions because they don't want to, they don't know what the outcome is. It's not predictable what the outcome is. And sometimes they rely very heavily on the entrepreneur and the senior management to guide them. So I completely agree with you that as a company, our intention is to build leaders is to build future leaders who will take decisions and where we'll delegate a lot. Our problem is that it's not that we don't want them to take decisions, but it's very difficult for them to take decisions because of the complex environment we work in. So, but hopefully sooner than later, that will not be the case.
Thank you. I think we have come to an end of our session. I'd like to thank Naushad, Sanjay, Sesh, and Ganesh very much. We had, I think, a very engaged discussion. We just not looked at the kind of broad picture about this environment that we have today. How do you balance growth, opportunities, and risk? But we also looked at some of the kind of more nitty-gritties of the tactics that we could do in terms of scenario planning, in terms of how you plan, have a base plan, and then you look at what kind of high-level plan that you have. How do you create, manage people, different views around decision-making. I hope you are able to take back some ideas and thoughts out of the discussion today. And once again, thank you, my fellow panel members. Thank you very much.